Hello guys, welcome back to another episode of Paris and Baz Cast, where we bring to you new guest speakers to talk about topics that impact property management, sales and finance, the three services we provide. Gosh, I've got this rehearsed very well every week. So the topic of discussion today is all about the trends in the Hills District market and whether it is a good time to buy. And joining us today is Arjun Paliwal from the Property Nerds. I love that concept, being able to bring you the numbers behind property, and InvestorKit, which is the initial company that how we've introduced and met each other. And I never forget the way you describe yourself, researchers that buy property. I think it accurately describes what you guys do. So welcome.
Thank you for having me. It's always good to see you too and be a part of the crowd in today.
That's it.
Welcome.
So today is all about, like, we've had this series going on for quite some time now, and some of the main sort of questions that we come across are: when is a good time to buy, and what is happening in the Hills District, which is where our office is located, and is it the right time to enter the market? You know, there's the concept of timing your entry into market or time in market, a whole heap of things. So we're here to listen to you today to enlighten us with all the numbers and data crunching that you've done, which shows whether it is a good time to buy in the Hills District or not.
Awesome. So I guess the first part around like just a good time to buy in general, I think one thing that we've noticed about Australian properties is it's very, very rare, going back like 50 years, for everything to kind of be taking off or falling at once. There's kind of, the last time it happened was kind of between 2000 and 2004. And so that's almost 20 years ago, when everything was happening together simultaneously across multiple markets. So the key is, if that doesn't happen so often, every single year, there's probably a market somewhere in Australia which is showing potential for someone to invest in and do well from it. So I think the whole good time to buy question, we can answer it as whenever you're in a position to buy and you've got adequate buffers, you're in a position to invest and have finance and everything like that, is a good time to buy. But when it comes to the Hills District in particular, there's a lot happening. And I think, there's a buzz in the air about the Hills District, and there's definitely some pretty exciting data points, which I'm more than happy to run through to begin with. So I might just share my screen, and then maybe you can kind of let me know to see if this is working.
Let's do this. Perfect. Yep, we can see that.
Perfect. So the first thing I want to shout out is there might be some unique terminology that I'll be bringing on today around data, and I'll do my best to simplify so many things and share as much about the Hills District in those simple terms. But hopefully with this new data, there's also some new learnings that can help people look at property and metrics in a different way. So the first thing I want to share with people is statistically reliable regions. Now, we always are hunting for the suburb, but sometimes the suburb isn't the right place to start. It's actually what we define as SA3. SA3 stands for Statistical Area 3, and it's defined by ABS census and used often there. And the whole purpose of it is to cluster a group of suburbs together to be able to get a data set that's less volatile and also more reliable, because we've got a good number of samples. Like, it would be, in your world, it'd be very rare for just, say, Glenwood to be doing well, but not Glenwood, Parkley, Stanhope, Ponds and all that. Like, they kind of have some sort of sync or synergy, right? And so this is where the SA3 gives us more statistical reliability. Now, what you'll notice for the Hills District, there are essentially 4 SA3s, but we're zoning in 2 of them. Now, the other 2 that aren't included here are kind of, going out to further parts of the hills like Dural and those areas, as well as the Hawkesbury side, Rouse Hill side. And the reason why we're not including those in the analysis today is largely because of low sample sizes in some of these more bigger markets. And then also a lot of new stock, which doesn't make reading data pleasant, because it makes it look like everything's oversupplied and everywhere, when really there's a new, there's a new stock data that you need to look at separately to then existing stock, for example, dollar per square meter rates and kind of, pre-release sales and all those different things that you look at that can't be captured on these basic charts. So the two areas of focus for us come under the Baulkham Hills SA3. And this gives you just an example of the suburbs included. Some of them may be familiar, West Pennant Hills, Cherrybrook, the beautiful Bella Vista, Castle Hill, Kellyville. And then the SA3 called Blacktown North has many hills or starting of the hills area suburbs like Glenwood, Parkley, the Ponds, and that northwest sort of region. So this is the two regions we've got on focus for the data, but I guess I wanted to just clarify the first concept, which was SA3s being the main kind of combination of the data together. Does that make sense before I move on to the next slide?
Yeah, 100%.
Awesome.
Technical, but awesome.
So the first thing I want to share is listings, right? Now, when it comes to listings in the area, there's obviously there's good and bad cases that happen from either increasing or reducing listings, but listings is just one part of the equation, sales volumes being the other. Now, what we can see is that the Baulkham Hills region, which is your Castle Hill, Pennant Hills, Kellyville, Bella Vista, has had a last 2 years of fairly consistent listings. It's had some up and downs, but there hasn't been a huge fall off a cliff or a huge jump up or any kind of major distress that's been evident in the hills of, Castle Hill, Bella Vista, Kellyville, that sort of areas. So you've had a bit more of a steady line even amongst COVID with some up and downs, but then it's kind of picked up to its standard trends. Now, in the Blacktown North region, you have had a little bit of an increase in recent times, going back to 2 years. It has come up a fair bit in terms of listings, but remember, there are going to be suburbs that are outliers that do carry a little bit more listings than some others. Places like Glenwood, the Ponds have actually been quite low in their listing levels, but then you've got some other suburbs which have picked up a little bit. So listing trends are trending up a little bit.
Or units, how does the housing in units compare?
So this is just houses that we're looking at. We're isolating houses in comparison to units. The whole analysis for today will just be the house market.
Houses, just want to make that clear, because obviously there's more of units that have come about.
Definitely. So I think the main thing here is to notice that we've got a great level of consistency in your Castle Hills, your Pennant Hills, Cherrybrooks, all that sort of stuff. And then in terms of your Blacktown and surrounding, you've got some suburbs that are very consistent, but some having some listings increase. Now, what can these two charts tell a buyer is that you're probably not going to see a whole bunch of, extremely discounted properties across the hills pocket, largely because there has not been this huge elevation of listings where there's lots of property online. There may be some pockets which might be a little bit, I guess a back and forth discussion or negotiation in some of the Blacktown North pockets, but a lot of it is still moving pretty quickly because when you remove a couple of high point suburbs, this trend is pretty flat, just like the hills, which is good. Now, moving into the next chart, we look at what we call incoming building approvals or incoming supply. So this is kind of thinking, well, yeah, Arjun, sure, the listings might be quite tight in the Baulkham Hills and surrounding areas, but is there a whole bunch of properties being built that might be built in the next 1 to 2 years? And house-wise, there's actually not a lot. The pipeline's very small when it comes to the first group of suburbs. And just to refresh memory, the first group of suburbs are these suburbs here under the Baulkham Hills SA3. And the second group of suburbs, as you can see, some, like the Marsden Park and Schofields carry a lot more stock than some other parts do. Hence why you need to go deeper into suburbs. But what we're seeing is 0.71%. Now, if I'm explaining what this is here, is that we've taken the last 15 months of building approvals. And when we've totaled the last 15 months, we're trying to say how many new properties are coming as a potential build in the next 1 to 2 years. And so what we're doing is making an incoming supply ratio, and 0.71 means for every 100 houses in the Baulkham Hills SA3, these suburbs here, there is only one being built that's going to come online. So there's not a lot of incoming supply. These areas are more built out than the other areas on the below list.
Could have to do with the land releases, because obviously that's been very tightly held. There isn't, when you go out there, there is not a lot of blocks of land left in those suburbs.
And we talk to developers all the time. They're struggling to find land and manage to get that.
These suburbs, this first batch is extremely tightly held. This first batch of suburbs is very tight, and I'm expecting a low wave of release of new builds coming up in these first batches. It's not the same case with the second batch. The second batch has had a few more approvals over the last 15 months, but that's again, not to say all of these suburbs. There's a few here that represent a lot more, like Schofields represents a lot more build than say a Glenwood would, right? Same with your Marsden Park would represent a lot more builds than the Ponds would, based on how much of the Ponds is already built out. So hence why you should take the data with a little bit of grain of salt in terms of, you know, how large the regions can be. But looking at the Blacktown North region, it is fairly high. So, the last 15 months has seen a lot of approvals come into the pipeline. Now that is slowing down in some pockets, but in some pockets it's been quite active. So we do expect a fair amount of building works over the next 1 or 2 years in those regions. And that can be an area to kind of just be mindful of, because if the high proportion of those moving into the areas are investors, then you can see an increase in vacancy rates to follow over the next 1 to 2 years. If you see a high proportion of owner occupiers, from what local knowledge seems to say is a lot of the buyers, then you kind of are a 1 for a 1 and you don't see much incoming supply.
Yeah.
So comparing the two, we've got 11 houses being built for every 100 in this SA3 versus 1 house being built for every 100 existing in this. So you can just see a very low supply market is expected for the first batch.
Is a lot of that being driven by developers, where they are now subdividing and developing larger number of blocks of land?
Yeah, definitely. I think the available land across some of these pockets, like Schofields, the subdivisions that occurred, that's definitely a big driver. But again, the new build data is a whole separate stream, because whilst there might be a lot of approvals, if they're all being priced at higher dollar per square meter rates, it actually still might equal growth if the absorption is so high. So we can't really look at it just for high supply, high risk, but there is a lot of new build incoming over the next 1 to 2 years. If a lot of that in these suburbs here is taken up by owner occupiers, then I don't see it being a huge risk. But if it's not, and a lot of people are investors who put it on the rent, then we could see some rental vacancy increase in some of these more newer build suburbs over the next 1 to 2 years. So that's kind of an initial high level thought.
So in a nutshell, I think the Hills district is still going to continue to pump for the next.
Yeah, I think that Borkham Hills part is looking phenomenally strong. This first batch of suburbs here are looking phenomenally strong here. Some of these suburbs are too, but then some of them get captured under the heavy new build data, which doesn't always make the data look as appealing. It's more a localized understanding kind of thing. So looking at the Hills district now from a rental picture, the rental picture for both of these regions has been pretty good for the last 2 years. We've seen a big squeeze down in rental listings in both areas. You can see them trending down. This is over the last 2 years worth of data. And this is phenomenal. This is causing a massive reduction. So if you look at it just 2 years ago, in the SA3 of Blacktown North, there were approximately 900 house listings for rent. And that's now dropped down to just over 200. So that is a huge reduction. And the same can be said for the Hills, the Borkham Hills pockets, a big reduction. So vacancy rates are actually being squeezed quite tight. They're not extremely tight, but they are much lower than where they were this time 2 years ago. So that's a promising trend.
Very good for investors.
Now what we do is we've created our own market categorization. And this is what we call a risk map. Now, with a risk map, I'll introduce a couple new data points. One is called housing inventory, and the other is called housing days on market. Now, days on market, the kind of listing point to time of sale. Yes, different agents will click time of sale in different ways, but it's still a pretty good measure to look at from a trend perspective. What we can see is for both of these regions, house days on market this time last year to now are extremely low. So when you're tracking below 35, they tend to be very low ratings, and both of them are quite tightly held. So if you're a buyer in these regions, don't expect you to have multiple open homes. Don't expect there to be things lasting on the market forever, because this low days on market, it was low last year and it's still low now. People aren't taking any longer to sell their properties comparison from this time last year and now. So that's a fairly low risk market for both vendors and also buyers. When it comes to the next data point, this is called housing inventory. If I'm to just explain housing inventory, let's assume 3.18. So what does that mean? That means that in all of these suburbs here, if you had a moratorium and said, hey, Anmol, Gudev, you guys can't list any more properties for sale in these suburbs here, how long would it take for all properties in that region to be gone and sold? And this is using the monthly sales volume average. So based on that average, if we look at inventory levels for the Baulkham Hills SA3, it would take 3.18 months to sell every single property that exists in all those areas. Now, that is a very low number, because I'm not talking about one sale. I'm talking about everything that currently exists in every suburb put together in Baulkham Hills region gone if you put no more new listings. Now, to understand what's a tight market, we looked at sort of the last 25 years of housing markets and the growth that can come in from levels of inventory. 0 to 3 months is classified as a very high pressure market. What typically happens is 0 to 3 months of inventory leads to reducing days on market or extremely low days on market. And that tends to lead to price growth in a 6 to 12 month following. So if inventory here is 3.18, we then classify it as a high pressure market. It's very close to 3, and that's last year. But as you can see, inventory's halved over the last 12 months. Now, if you saw listings going back to the first chart, staying pretty steady across the hills area, and then you see inventory half, well, that means people are buying like crazy. People are buying rapidly because they're taking half the stock off the market, aren't they? So that's a very, very promising point, because typically when we see markets with inventory below 3, they tend to correlate with 6 to 12% capital growth in the coming 12 months. And that's no small number. And we've played around with this data set a fair few times. So seeing inventory at 1.28 for this batch of suburbs is pretty much saying it's one of the lowest in Australia, because inventory levels are kind of 1.5 and below are some of the strongest markets in the country. So I would expect fairly strong price growth in this first batch of suburbs, largely based on inventory levels being low. And that is our assumption, because they're keeping days on market low and lowering, and inventory is falling, hence where we have a very low risk rating, and a score of 1 is very high. That's kind of our thinking here.
Wow.
That's the key. Get into real estate buy now.
Taking a look at the data for the Blacktown North region, again, because of the Schofields, the Marsden Parks, that can make your inventory look a little bit higher, because it sees a lot of rendered images for sale by like a developer on a realestate.com.au. Those don't necessarily mean there's 1,000 new builds for sale. They might just leave a rendered image online, and it kind of just is an ad to click on it or inquire about it, right? And so that can skew the data a little bit for some of the newer build areas. But what this is saying is inventory was a balanced market this time last year. It wasn't a very hot market. And it's now reduced to be a modest pressure market heading towards high pressure. However, if you do remove some of the outlier suburbs and you see a few of the established built suburbs, you will see extremely strong data points, which I'll take you through in the next coming charts. So now if we're looking at that, did you want me to pause for any quick questions or thoughts on that, or should I keep running through?
So what's the score is the risk of, what's the risk?
So the risk is assigned to housing inventory. So if we're in some of the lowest levels of inventory in Australia, like the first batch of suburbs in the hills, the risk is rated as extremely low because a seller selling is not going to have any issues finding a buyer when inventory is that low. And a buyer buying is likely to have, upon settlement, people missing out like crazy on their property, and they go in with a new sense of a bar of where pricing needs to be for the next. And that's kind of a buyer de-risking from growth occurring, from people paying more for the next and the next and the next kind of thing. So that's why it's a low risk market in overall sense. This number 5 score is kind of like balanced. And the only reason why it's rated as balanced is because there are a few suburbs within this patch that have a lot more available land. And as a buyer, if you have low choice, like you do in the first batch of suburbs, you have no choice but to compete. And it increases the people that opens, it increases the people having to put an offer down. Whereas if you're giving options of various new builds as well as an existing build, you're half in your mind between which one should we do. And that creates a less urgency behind a buyer. Now, this is not for the whole, like every suburb. This is just some suburbs kind of bringing up that data average. If we now look at the last few slides, and this is where it gets pretty fun, the numbers. If we're looking at the first batch and we say, okay, let's break it down to some of the strongest suburbs that we're seeing at a suburb level. Yes, we love the SA3 region level because it gives us clean data, but why not just take a sneak peek into the suburbs so we can see what's happening in the hills? Now, looking at the risk measurement that I told you on inventory, you can see here that almost all the suburbs have an inventory below 3. Pretty much every single one does. So all suburbs in the Borkham Hills SA3 region have extremely high pressure inventory. So you can expect 6 to 12% plus capital growth over the next year with housing inventory so low. If it sustains, that's our thinking. Now, what we can also see is days on market for buying a property. So sale days on market is extremely low for all of these suburbs, almost all of them below 35, with the more expensive Glenhaven slightly above, but they can take longer decisions for, some large scale purchases like that. But what we're seeing here is if you look at the inventory 12 months ago, you can see a reduction in all of them. 2.8 months of stock in West Pennant Hills is now down to 1.39. 1.94 down to 1.1. So Cherrybrook was already a strong market, but now if you see 1.1, it technically means if no new properties came to market, in 1 month, every single property in Cherrybrook's gone. There's no more stock online. Everything's gone. Bella Vista is extremely strong. 2.7 months of inventory last year is now down to 1 month. And 1 month is extremely low, guys. Just to let you know, like we have seen double-digit growth of 10 to 20% in some of the 1 month movements, just because if there's no stock, this is what puts pressure on. That same movement is quite clear. Kellyville is halved, Glenhaven is halved. So it's clear that we're in an extreme seller's market here. We're seeing very, very strong growth. And we can also see that by price median movements. There's at least $100,000 to $200,000 in movements over the last 12 months in some of these suburbs, which we can see here. Close to 200,000 in West Pennant Hills, close to 100,000 in Cherrybrook, 100,000 in Bella Vista and more. So we are seeing that 100K number hit of growth over the last 12 months. When it comes to days on market, the same thing's happening here. Sale days on market was 30 and 20s. You can't really get much lower than the 20s because it doesn't often happen. The clicking of that sold, it's now sold, is kind of where it takes that long. So it is at a very low point of days on market as well for buyers. Now, the only thing I would point out is vacancy rate. So you can see whilst the trend of listings is declining, which means the rental vacancy market's getting stronger, they are getting stronger from high points to balanced points. Other than a couple of suburbs with vacancy rates in the ones, places like Glenhaven, Castle Hill, Borkham Hills, and Cherrybrook, they've moved from a high supply of rental markets last year to balanced/tight. There are some very tight markets outside of these regions, but this is still a healthy trend for a region to move from vacancies of 4.6 to 2.7, 3.6 to 1.1, 6% down to 2, 3.4 down to 1.9. So we're seeing a very healthy trend of both vacancy rates fall, inventory fall. We're expecting rents to rise, and we're expecting house prices to rise over the next 12 months with these two.
Great news for sellers, but not so good for buyers.
Yeah, I mean, buyers, you've already missed out 100,000 in these areas over the last 12 months. So I think yeah.
Exactly, that's true. With the trend, then it's better to buy now than to wait, because it's going to grow anyway in a year's time. Might even sell in a month's time.
Yeah, I mean, these are very, very strong data points for, such premium markets. It's moving very strongly. So that's the markets of the Borkham Hills SA3. This is going to help explain the Blacktown North and how we saw a few weaker data points as a region. And that's because there's a couple of outliers. So outlier number 1, Riverstone, outlier number 2, Marsden Park, and outlier number 3 and 4, Schofields and Collerby. So I would almost isolate those data points, because when you have new rendered images online or new builds, it can make the data look very skewed, just because it looks like there's a whole bunch of properties online for sale, when really, when you call some of these developers and they have the image up there, they'll say, look, it's all gone. Like, we have nothing there. The image is just left online. So the key is to look into that a little bit more deeper.
Yeah,
Right?
that's what these suburbs now, like, very tight as well. But going back a couple of months, it was a lot of stock. So
and then looking at some of the tight suburbs here, Acacia Gardens and Quakers Hill. Quakers Hill has been a huge change. It's getting quite strong at 1.51 months of inventory. Glenwood is the strongest amongst them all, with 1.03 months of inventory. So you can see, again, other than removing the outliers, this becomes a very strong data set for a region. And again, it shows you what we saw on the last slide, which was high pressure.
Yeah.
We're seeing days on market quite low as well, in the 20s, 18, 19. This is extremely low, because again, it's not from the actual day of contract, it's when it's marked as sold. So this can take some time, which means all these properties could be actually have been sold in the first week. It's just that they're being marked as later, which makes it a 20 to 30 days on market. So this is very
we're seeing as well, like first open, but obviously the cooling off period and everything, 10 days or 5 days, whatever that might be, it makes the.
I think it's really like a couple of days on market.
correct.
Yeah, so I guess in a nutshell, the question, is it a good time to buy in the Hills District?
Well,
yes.
If we're looking at that question, I would say that if you're in a position to, and you are looking to buy, with inventories this low, we typically can see up to double-digit price growth. So delaying a decision is going to make an impact. But again, it comes down to each person's capacity, capability. The main thing in this type of market is to be more in tune than ever. And by in tune, I mean not relying on comparable sales longer than 1 month even. Sometimes 2 months is a stretch. Typically, investors, when you're looking at it, look at comparable sales up to 6 months. When you're operating at inventory this low and $100,000 movements in 12 months, this is not an inventory market where you want to play with long comparable sales. You'll find yourself missing out every single week that you go. You'll need to kind of, find your own sweet spots, buffers, capabilities, and then from there, use comparables as recent as possible, and not even sold. Go to listed, speak to the agents about what things are selling for, sold for, under contract for. If they're not giving away the exact numbers, do your best to walk away with the range at least, so you kind of get some comfort, and just really leave with some analysis of what's happening now, because inventory this low does mean things change pretty quickly.
Very quickly, exactly. So some of the questions that we had, one of them from Shreya was about future development and land release areas. I think that's a topic in itself, because there is from what is coming up, there is definitely a lot coming up. But is there a key fact that you can provide there? Anything particular that you've seen? Any trends?
Yeah, so I think there's been no question that the stimulus that's come in recent times has been a massive change and impacted to the take-up of new builds over the last 6 months. And so what I feel we need to be aware of is that there is a huge amount of building approvals in the pipeline for some of those suburbs that I gave you on that first screenshot. Not for the first batch in Baulkham Hills, that's quite low, so I don't think there's any risk there. But in the other region, there are suburbs like your Schofields, Marsden Park, Riverstone, that, you know, if you're caught out in stimulus level dollar per square meter rates versus non-stimulus and kind of where the market's moving and the appetite, and that can create some difficulty in analyzing where you feel something's worth. So I would say, yeah, look, there are going to be more supply to make up for the demand that's kind of just been swamped into this market right now. But at the same time, there are a lot of people who are going to move into built dwellings, meaning that this level of demand for new builds is not going to sustain the way it is currently. So I would say it's hard to say, because what gets released, there is available land, not in the first batch of suburbs, your Castle Hills and things like that, but in the second batch of suburbs, there is. So yeah.
Hills District, I think, is always going to stay premium. So you just got to.
Yeah, if once you enter the market, you're not doing the wrong thing. But then again, it depends on what they're wanting to do. Like if it's a purely investment-based decision, then, and you know, budget-based decision, then it makes a difference with the average prices. And now the last question that we had was from Sahil Khurana about, is it a good time to buy a piece of land with already inflated land prices and build $1 million home or townhouse in Kellyville? Or should he wait until the dust to settle? Based on what we've seen, it sounds like the next 6 to 12 months are pretty strong.
Yeah, Kellyville's a very strong suburb at the moment, data-wise. Looking at Kellyville here, just to give you some context, inventory levels are at 2.81, so it's a high-pressure market. Days on market is fairly low. It's lower than what it was this time last year. This time last year, days on market was 30. It's now down to 26, so a 10% faster selling in the last 12 months. Prices are up at least 150,000 or more over the last 12 months. So from that perspective, I would say that Kellyville's current level of inventory shows that price pressure is likely to remain over the next 6 to 12 months. I can't comment on certain pockets where rates of land release or things coming up could happen, but Kellyville right now is in a high pressure situation.
And there's no other major land release that can happen in Kellyville because it's mostly all built out now. But unless you go further out towards North Kellyville.
That's where. Now, in terms of if we were to compare a buying land and building and reselling versus buying an already established property and reselling, let's talk a little bit about that. I know we're conscious of time, but what are your in the market that we are now? Is it cheaper to buy land and build, or to buy an already made property? I'll ask your opinion first, and Arjun, yours.
Yeah, I think in today's market, probably buying established dwelling is probably cheaper because land prices are through the roof.
And construction costs.
And people are prepared to pay a couple of $100,000 more for land now just to build their dream home. So I think if you're going to buy your dream land and build a dream home, I think you'll be paying more than established dwelling. But then you got to compromise on the house. Is it what you exactly want? But that's what I'm seeing in the market. Because land prices, especially in the Hills District, it's through the roof. I would say they've nearly doubled. Or yeah, it depends on the suburb, but $500,000, $600,000, $700,000 we've seen increase in the last year. Which is right.
Arjun, what are your thoughts?
Look, I'm an established buyer all the way. I'm in agreement there. And the reason, I think firstly, the Hills area, its established homes are pretty beautiful. We're not talking an area that's needing to go through gentrification. We're talking an area that's always had that class about it. Distance to CBD is not a measure of any sort of success here in the Hills. Because it's always had its own, feel about it. So I kind of think that when you're going into established homes, there always is going to be that character appeal, the land size that you can get. And I feel that when you're looking at some of the new builds in today's market, the dollar per square meter is just out of this roof. And I also feel with the square meterage that you're getting, what's going to be your X factor when it comes to sell? A home in Castle Hill, a home in Glenwood, a home in Bella Vista, each of them are just so different to each other from street to street. Whereas when you have that new build and you're just trying to chase that dollar per square meter, I mean, getting it as good as you can in some areas that just keep pumping them out, could you make some dollars on the way up as the building's happening? I'm sure you could if this level of demand sustains. But if you're talking about a home, the land that you can get, and being in a market where it's always going to have that feel about it when it comes to those established homes, I think that's kind of my pick for long-term wealth creation as well.
And the real value is in the land as well.
That's what's going on.
Depreciate. Yeah.
That's right. We've got a question from Dheeraj. Is Box Hill worth it? Box Hill, what are your thoughts?
So this is where it gets interesting. The Box Hill, Rouse Hill, and surrounding markets, they're not data-driven decisions. And so what I mean by that is you have to be in it. You have to know what every lot is selling for. You have to know what things are going for, the rate of releases, how many people are showing up, how fast things are going. They're not really suburbs that you can make a data-driven decision by. And the reason why is because they are fairly new. Whenever you're looking at the Box Hills, the Rouse Hills, as a person who kind of leads my investment decisions by numbers, I get a bit scared of how much supply in the pipeline there is that's going to be built in the next 1 to 2 years. The pipeline sitting in those areas is 17% plus, which means that for every 100 homes that are already there, there's 17 new ones being built. Now, I don't know any area that's kind of getting 17, 20% population growth, which means I'm sure that there's going to be a large amount of investors that try and find a tenant and they're still looking around trying to find them. So I kind of feel that when you've got so much availability of something, it's not to say it can't grow. As you said, Gurudev, the dollar per square meter rates have been pumping. But the thing is, there's just so many unknowns. So for me, I just can't make decisions if I have too many unknowns. So I feel like they're more there for people who live in the area, specifically of that suburb, do nothing but go house hunting for land every single weekend. They see what they were last week. They see what they are tomorrow. They see what their friend bought it for 3 months ago. Those are the people you want to ask on how the Box Hill's going. I think for me, as a data and research encompass of this all, it becomes very less data driven and more feel and locality driven.
Box Hill just doubled in the last 2 months, I think.
I know.
Right. So I couldn't have told you that from data. It's just there's so much things that happen in the new build world that you can't capture from an analytics online kind of thing.
That's it. The other question we have from Sandy is it a good time to buy an apartment? What is your take on apartments?
Yeah, so look, I mean, personally speaking, I feel that if you're buying an apartment to live in, and that's a personal choice for you to, downsize, low maintenance, and there's many other factors, go for it, right? That's your call, that's your lifestyle, that's your preference. But as an investment, I typically find those looking to buy an apartment are doing so because they're not aware of houses across various parts of the city or the country that you could get for the same price. And so I feel that if you're truly looking at an investment, the apartment should be the last thing that comes to your mind, only because, again, less controllables. Once Castle Hill's fully built out, the inventory that comes online is only dependent on the listing behaviors of people, not by what gets built, not by what zoning changes. Once one unit comes up in Castle Hill and you like it, and then 100 more come up, it's so much constant change that can occur without you being in a controlling position. And if I've ever found the most successful investors, they are usually those who can say, I made a decision and I controlled whatever I could in my own hands. And there was very few that I couldn't control, very few data points or very few decision-making points. And as a result, I felt I was the most informed when making that decision. Yeah. So my thoughts there are, if you're living in it, awesome. If you're not living in it and it's an investment choice, first just see what you scoped out. That's part one of the answer. But if you are going to look at one thing I find very intriguing at the moment for apartments is in Sydney in particular, we're seeing some of the largest price gaps between houses and apartments. They're really spreading. And so typically there will be a bounce back at some stage of apartments coming back to their long-term historic gaps between house prices and apartments, which means that there may be a bounce back in growth, but I wouldn't have that as my main feeling factor to go for it. I still think there's so many good houses you could choose from all across the country.
Across the country, I think that's the main thing. If it is price driven, it's worth having a chat with a buyer's agent like yourself to see what your options are. the level of return that you can get. One other question we've got from Dheeraj is Canberra market worth investing?
Yeah, pardon me, the picture that you saw in Borkham Hills with inventory levels of 1.39 in West Pennant Hills, Cherrybrook 1.1, Bella Vista 1, that's a ditto picture of the Canberra market. The Canberra market is currently the lowest inventory market for houses in Australia. So the highest level of pressure is sitting in Canberra for its house pockets. In capital cities, that is. In some other regional cities, there's some very strong markets too, but capital city-wise, Canberra house markets are extremely strong. And it comes back to that inventory level. Buyers don't have a choice. All stock could be gone if new stock did not come on in a very low amount of time. Things are selling faster, vendors are discounting less, and that connection between the three data points is showing in Canberra.
What is driving that? What's Canberra?
Yeah, so I mean, look, I think one thing that's very important is that the job market in Canberra wasn't as impacted as many other pockets of the country. That's one key factor there. That's a massive differentiator for Canberra. But right now in Australia, in such unique times, we're not just calling it one thing. People are thinking, is it interest rates that are driving it? That's one factor, but it's not the only or the main factor. How we've handled the pandemic, the stimulus and support that's come out, the interest rates being low, investor participation is a big one. If you look back at the last 5 or 6 years, there's been so many large scale events from Credit Squeeze, APRA, foreign investment review boards. There's been so many things, and those have come together to create low investor participation. And that creates a squeeze on housing demand because there is not enough rental dwellings. Rents start picking up. When rents start picking up, renters question whether they're looking at an area and whether they should buy there or live there as a tenant. And they can sometimes join the owner-occupier pool. So I feel there's not one thing that's driving a city at the moment. There's so many factors that make Australia stand out as a very strong market. But funnily enough, we're actually not one of the strongest. Across the ditch in New Zealand, we've seen house prices grow by over 20% in the last 12 months across many pockets. So this is it's a global phenomenon of what's happening in many different countries, but we are definitely holding our own from a life and housing perspective.
There you go. Well, that was a very informative session. I'm sure a lot of our viewers that are still watching got a lot out of it. Thank you for all the questions that we've had while we were live as well. Any final comments before we wrap up?
No, all I can say is that with trends like these, the Hills market is looking pretty strong. I think the key thing is that there is a whole different analysis of new and established dwellings you have to take on. But the established market has some of the lowest inventory in Australia, which has a correlation with growing prices in the coming 6 to 12 months. And also vacancy rates are reducing, although they're not the strongest in the country, the inventory is, but vacancy rates are getting better, which is also promising. The key thing that you can do to de-risk an investment decision long-term is have as many controllable variables that are there. And this is where buying established can make a big difference.
Absolutely. Thank you very much for enlightening us. A lot of our viewers are thanking us as well. Well, next week we're going to be talking to a Melbourne-based agent to discuss the lockdowns and how that's impacted the Melbourne market, as well as overall, just what has the trends been every single time that there's been a lockdown, what has actually happened. So stay tuned for that one if you are looking at investing in Melbourne. We'll be bringing you some insights there as well. Thank you very much for watching, and thank you very much for joining us, Arjun. We will see you guys next time.